Hi, I'm Craig Novorr with Paragon Capital Management. We've done several YouTube videos about structured products. We've done an overall structured product video, and we've done specific videos talking about growth notes and income notes. There are a lot of videos on YouTube and on the internet about structured products. It's becoming a more popular topic out there. There are either people that are very negative to structured products, or there's people that are very pro structured products. When we look at a video on YouTube or on the internet or read somebody's material, a great question to ask first is, what is their background? What is their biases? Do they have an objective in trying to lead you either for or against any investment product or any product in general? One of the things that I've heard over the years, and I really love the expression, is if you're in the business of selling hammers, then everything looks like a nail. So if you do not sell structured products and you have clients asking you about them, doing a video that makes them look bad is in your advantage because you want to explain to people that your investment style is better than theirs. Some of the biggest complaints that we hear in some of the videos is talking about the fees. We also hear people talking about the risks, and we talk about how complex the investments are. And those are all extremely valid points. If you've watched any of our videos, you will know we address a lot of those things in our videos as well. There are two very distinct types of structured products out there. There are structured products that are created and sold in the retail environment, and there are structured products that are created and sold in the institutional environment. In the retail environment, you tend to see very high fees. You tend to see notes that have built-in commissions or front loads that go to the person selling it. You tend to see higher fees to the issuing banks. And in a lot of cases, especially with growth notes, you see them capping your returns on the back end, limiting how much money you can make and putting more money in their pockets. Those are all things that I'm vehemently against. We absolutely do not condone buying any kind of structured product that has those front loads, that caps the returns on the back end, and has high fees built into them, because those all hurt the investor. But when you're looking at institutional type of products, we can control a lot of those fees and limit those to make them actually advantageous to the client. One of the nice things about structured products is the first word, structured. What that means is that we can customize an investment specifically to what the client is looking to do. Is a client looking for growth but also wants downside protection? Is a client looking for specific income? Are they looking for specific duration? Are they looking to hedge against a specific index? There's a lot of advantages to using structured products and being able to match what the client's goals for his portfolio are with the investments within the portfolio. The videos often talk about unsophisticated investors. And let me tell you, I've been doing this for almost 30 years. Even professional investors are unsophisticated when it comes to products they don't do in their daily lives. Hedge fund managers do hedge funds. Publicly traded managers deal with publicly traded. There are fixed income specialists. There are equity specialists. Not everybody knows everything about every product. And so everybody, in a sense, is unsophisticated when it comes to something they have not used in the past. And that is where education comes into play. If you are going to use a structured product, it is important to work with somebody who can explain it to you in a way that is simple and makes sense. If you watch our videos, we try to illustrate the notes in a way that is very simple and easy to understand. We explain to you why the banks issue the notes and how they structure them so that they make money and that you make money. It's a little disingenuous of some of the people that create these videos that are professional investment advisors. Some of them are hedge fund managers or private equity managers that are saying very, very negative things about structured products and basing it upon the banks making fees, when in fact, as an investment professional, they're in business of making fees. And so in any industry, whoever is selling you a product has got to make a living and has got to have fees in that. The question is, do you understand, is there transparency in the fees that you're paying? Can they illustrate to you exactly what those fees are, and then evaluate your investments on a net of fee basis so that you're comparing them apples to apples? If you do that, then you can clearly decide for yourself if a structured product is something that fits into your portfolio. It can be a sleeve or a part of your portfolio, or it could possibly be your entire portfolio. But the key is to mitigate the risk with diversification, laddering of different structured products so that you don't have all your eggs in one basket, and understanding all the risks that are involved so that you can properly address those and feel comfortable with them. Even though we do structured notes for our clients, we offer a full spectrum of investment options, going from traditional stocks and bonds to structured products, to private credit, to private equity, to private real estate, to whatever it is that the client needs to fulfill their goals. As a fee-based investment advisor, myself and my firm, we charge a management fee on the total value of the portfolio. If the portfolio rises, our fee rises in the same percentage. And if your portfolio decreases, our fee decreases in the same percentage. It's sitting on the same side of the table as our clients, trying to protect them from downside losses while achieving upside returns in a way that reduces risk as much as possible. We do feel very positive that structured products play a big role in many of our clients' portfolios. In the future, that may or may not change. We're constantly reevaluating. We're constantly looking at other investment options, and we'll present the proper investment options to our clients when those opportunities do arise. We have spent the last almost 10 years doing structured products for our clients. We have done hundreds of millions of dollars of structured products, and we feel that we understand the risks and we understand how to properly structure them in our client's best interest, to the point that we offer them as a separate account management to other registered investment advisors. There are other registered advisors that are strictly focused on financial planning or other aspects of the investment community and do not have an expertise in some of the things that we do on the alternative side. And they come to Paragon for our expertise and ask us to manage a portion of their clients' portfolios in structured products or other alternatives. It is that expertise that allows us to be able to convey to both the clients and the advisors all the risks that are inherent within notes and all the benefits that are within the notes. Like anything else, structured products are an investment that are a good fit for some and not a good fit for others. When you're watching a video like this, it is important to evaluate this investment as part of your overall portfolio and keep in mind that past performance is not an indication or a promise of future performance. It is a good idea to sit down with an investment professional and discuss all the risks and the upside of using products like this or any investment product. If it's something you'd like to discuss with us, we'd love to set a time to sit down with you, either in person or virtually, and discuss your portfolio, your situation, and how structured products might be a good fit for you. I'm Craig Novorr with Paragon Capital Management, and we hope to hear from you soon.